We're going to go ahead and get started here. Good morning, everyone. This is Tyson in San Diego with the Retirement Group. Today we are going to be discussing the at&t pension. Now, if you would, please mute your mics just so we can get a better, clearer recording here for the class. So before we actually get into talking about the pension plan and the history, I think it's important that we stop and realize why this is important for us to know as advisors here at the Retirement Group. Very importantly, we differentiate ourselves from our competitors by knowing the benefits plans of the company that we work with. at&t has a very unique pension plan, which has gone through a lot of changes. It's very difficult for many of the employees to understand, and we create a lot of value by helping them realize how their pension works and letting them know all the options that they have to take their pension, and most importantly, when's the best time to leave the company or to elect my pension to get the most money. The most important criteria for the pension that we want to know about is 30 years of service. Once the employee gets 30 years of service, they are known as what's service pension eligible. There's a couple other ways they can become what the employees call SPE. Most importantly, Mod 75. There's 3 different criteria that an employee can be Mod 75. The first one is 25 years of service at age 50, or 20 years of service at age 55. And the last one is 10 years of service at age 65. So it's called modified 75 because the employee has to be one of these 3. They can't be 47 years with 28 years of service. They have to be one of these benchmarks, and then they get service pension eligibility. And keep in mind, management employees will still have age penalties on their pension, which we'll talk about what those are in a bit, if they are under the age of 55. Non-management employees will also have age penalties unless they get their 30 years of service, and they no longer have the age penalties, and they are fully pension eligible. So before we start talking about the arduous management plans that have changed a lot over the years, let's talk about the more simple craft pension. A craft is what at&t employees call themselves if they are a non-management union employee. And to calculate their pension, you take their pension band, which is assigned to them as an employee based on their salary or their wage, multiply that by their years of service, which at&t employees call NCS, or net credit service, and that's going to equate to a monthly annuity. And if any apply, you're going to want to subtract age penalties off of that to come up with their monthly annuity payment. Now, like we talked about, the pension factor band, the pension band factor is based on their job title. Any age penalties that will apply will only be if they have less than 30 years of service, and they're going to be 6% a year for every year under 55 at that point, which is 0.5% a month. Once they get their 30, they no longer have age penalties, so you hear a lot of the craft people waiting until they get their 30 years before they even think about retiring. It's very common. So let's look at an example here. If somebody who is a craft employee has 26 years of service and is 53, they are going to be Mod 75, but they will have 2 years of age penalties, which is going to be a 12% haircut on their pension. Now, another example, if they are 56 with 21 years of service, that person is also Mod 75 because they have their 55 20. But they are not going to have any age penalties because they have 55 years of age. Now let's talk a little bit about the history of the company before we get into the management plans. So the company started in 1877. Alexander Graham Bell invented the telephone and started American Telephone and Telegraph. It wasn't until 1913 that the company produced the very first defined benefit pension plan, And this is a very important one for us to know because although it does not exist anymore, it is no longer relevant, but this is the pension that all of the future pension plans would be based off of. So you take their 5-year average salary, multiply that by 1.45% times their NCS, subtract any age penalties, and that's going to give you an annual annuity, which you would just divide by 12 to get their monthly annuity. Now keep in mind, for both craft and management employees, they do get a lump sum option on their pension. And we'll talk a little bit about the differences of that lump sum in a bit, just because of where the pension plan has gone today. But to get that lump sum amount, we just have to use current interest rates and the individual's life expectancy. It's an actuarial calculation that we can use an annuity table for, or we can just go onto their benefits administrator Fidelity's website and run a pension projection. And most of them are familiar with the benefits site, but not all of them are familiar with how to run the projection. So that's where we can create a lot of value in helping them run that projection, and we'll need that number for our retire kit that we do for them. Now, for the management employees under this salaried pension plan, the age penalties were the same for the craft, 6% a year for every year under age 55. A very simple plan. It's just a classic defined benefit formula-based plan based on final average pay formula and their service. And if they do not hit their pension eligibility, they're going to have severely reduced pension benefit, and we'll talk about that in a bit. So moving along, the company grew pretty fast, and the United States government actually encouraged it for efficiency purposes to give them a natural monopoly. But what the country wanted at the time was everybody owning a telephone who wanted one. So there was vast growth by at&t and in the industry to make sure that that goal was attained. And by the 60s, everybody who wanted a telephone had one. As you can imagine, the company grew huge by this time, and there was some monopolistic practices going on, which became a problem. And this resulted in the Justice Department slapping at&t with an antitrust lawsuit. It took a long time for this to be completed. It's about 10 years. But the result was what they called the divestiture, which split up the company into the regional bell operating companies, or the 7 baby bells being the biggest ones that we think of, listed here: Ameritech Bell, Atlantic Bell South, Pac Bell, NYNEX, SBC, and US West. at&t still existed as a company at this point, but their operations were very limited. So fast forward 10 years, and we have Pac Bell coming out with the first early retirement incentive offer, which they called an ERB, and this one was a 3+3 in 1991. And they still have these ERBs today in California primarily. They're 4+4s usually. But what that 3+3 means is they're going to add 3 years to both the employee's age as well as their service to help them achieve pension eligibility earlier than they may have, to incentivize them to leave the workforce. Now, they have to do these with the non-management employees because they're protected by the union. The management employees won't see these because they can just give them a severance package and separate them from the company at will. But for the non-management employees who tend to stick around for quite some time, they have to incentivize them out of the workforce, and this is what these early retirement offers come into play. So 1996, this is a very important year for at&t. This was the year that SBC purchased SBC purchased Pac Bell, or merged with them. and they came out with a couple new pension plans as a result of this. Now, the reason they were allowed to do this is because this was the year that Bill Clinton signed the Telecommunications Regulation Act, which has just allowed the companies in the telecom industry to have a larger market share or grow back to the size that they used to be, as at&t was before '84. So the first pension plan they came out with was called the Cash Balance Pension Plan. This plan still exists today. It's much different than any of the other plans that the company has because it's a defined contribution plan, which means that the employees get service and interest credits over time and do not have the stringent age and service requirements to become eligible for the plan, meaning the plan is fully portable once the employees leave the company, if they have vested for the plan. So, can we have everybody mute the microphones recording here? So this cash balance plan came out in 1976, and if you were a management employee before March 22nd of that year, you were vested immediately, and you got what they called an opening balance on the plan. If you became management after that time, you had to wait 3 years to qualify, and you did not get the opening balance. We'll talk about what that is in a second after we take a look at the calculation here. So the opening balance, which was calculated by taking their 12-month average salary multiplied by a service-based factor, and that service-based factor is just an actuarial table formula that allowed them to equate this cash balance pension to a lump sum. So you take that opening balance, add on every month 5% of their monthly salary, and then you also multiply it by the 30-year Treasury rate, or the GAT rate, so it's growing on a monthly basis. Now, this gives this pension plan an exponential growth rate as opposed to the quasi-linear growth rate that we see out of the defined benefit plans. And we'll see why that's important in a second, but basically what we see is this cash balance pension plan coming in